Yeah, hi, good evening, Ritu.
Hi. I'll just give a brief introduction and then probably we'll start with the Q&A.
Sure, sure.
So hello everyone. Welcome to today's session of Power Talk, and I just welcome Mr. Ajay Tyagi. In today's session, he is head of equities at UTI Asset Management Company and having more than 20 years, 22 years of experience. I'm sure you all must have heard in some or the other forums to Ajay. And in today's session, actually, if we talk about the stock market, then stock market has various kind of patterns we call cycle. The natural cycle of markets where we see that the stocks generally rise and fall. There are several reasons why stock prices fall and rise. Um, uh, Similarly, if in the current market scenario, if we talk about there are the various factors like talk about the global situation and its impact on Indian economy, interest rate cycle, whether Fed will increase the further rate hike they will do or not, and Indian central bank will follow that. Geopolitical things are there. So there are multiple factors at one time we see in the market, and that actually drives market in the different directions. Uh, Even if you talk about the investor's point of view, then investors' expectation or perceptions also affect the stock prices. Without wasting much time, my first question to sir to you is in process of building portfolio, how easy or difficult for you to stick to your investment philosophy, regardless of whatever happens in the stock market? And it would be great if you can help our audience to understand what kind of investment philosophy UTI broadly follows.
Sure, sure. So I'll try and do that. Can you see the presentation in front of you?
Yes, sir.
Okay. Uh, so first of all, welcome everyone, and thanks for having UTI on this discussion. I think as far as our processes are concerned, let me broadly tell you that we follow a process where we basically tell each of our fund managers that please run your fund with the philosophy and the mandate that you have been given. So if you are a value manager, you need to run your portfolio with that particular mandate. You should not own stocks like Bajaj Finance or maybe a Kotak or maybe a high price stock like Info Edge. Pick up the value stocks there, construct your portfolio using that framework, but more importantly, stick to it. Internally, we have a framework which is known as the R1, R2, R3 framework and C1, C2, C3 framework. Without going into greater details, let me just let you know that R1 companies are the ones which basically have the highest return on capital. R3 companies are the ones which have the lowest return on capital. C1 companies are the ones which have the strongest cash flow generation. C3 companies are the ones which have the lowest cash flow generation. Uh, Now, as you can see over here on this slide, now when we talk about our value style, you would see that the value style will have more and more of the C2 and C3 companies and R2 and R3 companies, because they are basically looking at businesses which may have been doing poorly right now, but they do possess some longer term competitive advantages, because of which they can improve to let's say from C2 to C1 or C3 to C2 or maybe R3 to R2 or R2 to R1. So that's the typical way a value manager in our framework would operate. The growth or the quality manager will stick to C1s and R1s. They would never try to buy something which is in C2 or C3, meaning which generates poor cash flows, or not wanting to buy anything in R2 and R3. When I say anything, they could have a 5, 7, 10% exposure, but 90% of the exposure ought to be in C1 and R1 companies. So I think that's one framework which basically allows us to identify how different fund managers are behaving, and we broadly track and monitor them on this basis. And then we keep guiding them and supporting them that, look, please don't come out of this framework just because maybe your style is not doing very well right now. Uh, Let me now talk about the changing moods of the market and how things keep moving around. So this is data for the last 15 years. What we have done is we've basically taken two benchmarks. The first one is Nifty Value 50. The second is Nifty 200 quality. So it's a comparison between, let's say, the value and the quality leg of the market, between Nifty Value 50 and Nifty 200 quality 30. So let's call them, simply put, Nifty Value and Nifty Quality. Let's not complicate the names. Now, over this 15-year period, wherever you see yellow, it signifies that quality has done better than value. Wherever you see blue, you would see that value has done better than quality. So let's say starting 2000, I would say 5 and 6, value did much better. I'm sorry, quality did much better. And then starting 2007 till 2008, value did much better. Then we had a brief period. This was a period of Lehman crisis. In between, maybe a short span of 8 or 9 months, everybody wanted to be in high quality stocks. So therefore, quality did well very briefly. Post that, again, we had a time period where value continued to do very well for more than 2 years. Then came the phase of 2011, 12, right up to 13. This was the phase of the UPA 2 government, and many of you would recollect there was a commonly used phrase called policy paralysis. The government was not doing well. Inflation was very, very high. Rupee had depreciated by more than 15%. So it was a very poor period. And quality stocks again did very well for those 2 years, followed by a sharp Modi rally, and value stocks did well. So in this chart, you can keep seeing that every 2 or 3 years, I would say 2 years, not even 3 years, the baton just keeps getting passed on. And these numbers are relative outperformance on a 1 year basis. So you can imagine, if I look at December 2014, there was a point when the 1 year difference between value versus quality was as high as 70%. So that means that there was a point of time, sometime in calendar 2014, let's say 31st May 2014, when the value index, if it went up by 100%, the quality index went up only by 30%. That is why the difference was as high as 70%. So the difference can be very, very stark. I'll show that in a subsequent slide to you. And this kept happening. Currently, we have seen the strongest value rally ever in the last 15 years. So it's been going on for 2 years now. And it's still continuing. We don't know for how long it continues, but yes, if you look at these patterns, possibly it's already overlived its life. Same exercise, this time we are measuring value versus Nifty 500. So instead of value index versus quality index, value index versus Nifty 500, the results are very similar. In fact, if not the same, they are very similar. So it just tells you how moods change between these two extremes. Now, this is an interesting slide which tells you how each of these styles have performed on a point-to-point basis. So last 1 year, value has delivered 23% return, quality has returned 5.1. The broader benchmark, which is a mix of both quality and value, has delivered 10%. Last 2 years, value has delivered 44% CAGR. Quality has delivered 18% CAGR. The broad market has delivered 23%. Likewise, in 3 years also, value has delivered 27% CAGR, quality has delivered 17% CAGR, and Nifty has delivered 19. Usually, we see that whenever these changes happen, a 1, 2, or a 3-year period can be extremely in favor of one versus the other. As you keep talking about longer time periods, you see convergence. So if you were to take a very long time period like 7 years and 10 years, then you see there is hardly any difference between these three distinct benchmarks. So over a 7-year period, value has delivered 13, quality has delivered 13.5, broader market has delivered 14.5. Over a 10-year period, value has delivered 13.7, quality has delivered 15.4, and the blend has delivered 14.4. So that's the broad message to you. This will keep changing every 2-3 years. The narrative, the mood will keep changing. There is no point you trying to catch any of these changing moods, because the minute you try to attempt that, you may actually get trapped on the wrong end. So what we do at UTI is we basically focus on our style and continue with that style for a long period of time, so that we can capture the recovery in that style also very, very swiftly. And like I said, longer term outcomes are not significantly different. You need to stick to your style. Yeah.
In the previous slide, we have seen you have shown that the various cycles of value and growth. So, can you explain how the macro actually plays a role defining these cycles? And at the current time, is if we talk about how what kind of a style you are believing, like going ahead, that will the macro will support that particular style.
See, I would say, the biggest factor determining this is always, uh, the level of interest rates, and also the mood in the market. Whenever the mood in the market is extremely positive, you would see value stocks doing much better. Whenever the mood in the market is pessimistic or negative, people would want to stick with high quality stocks. So that's one way of judging the behavior. So 2000, let's say 3, 4, 5, and up to 2006, the mood of the market was extremely cheery. So you had a very strong value rally. Post that, around the Lehman crisis, the mood of the market became bad. So you basically had a growth. You saw growth outperforming value. Basically, both fell. Even quality stocks fell, value stocks fell as well, but quality outperformed growth. And then again, had a period when Indian economy was not doing very well. Like I said, the policy paralysis period 2011, 12, 13. At that time, quality did much better than value. So to some extent, if the mood of the market is extremely positive, and there is a risk on rally that is happening, you would on an average see value outperform growth. That's one way to look at it. The other way to look at it is simply interest rates. Now, growth stocks are what we call as long duration stocks. These stocks throw out strong growth for years and years to come, decades to come, I would say. So you can see, let's say, a Bajaj Finance growing at maybe 20% for another 10, 15 years. And beyond that, it may not grow at 20%, it will still grow at 15%, which is a very strong growth number. But you can't say the same thing for an ONGC, because ONGC within the next 10 years will see peak oil demand, because the world is replacing fossil fuels with a lot of other things. You will see peak oil demand. After that, oil demand will start to come down. Therefore, the profits of ONGC will also start to come down. So ONGC is not a business which will be alive for 50 years. But yeah, Bajaj Finance is a business which will be alive for 50 years. I mean, of course, we have seen HDFC Bank being alive for 25 years, HDFC Limited being alive for now 45 years. So, Bajaj Finance will also remain alive. Banking as a business will continue to grow. When interest rates increase, the common logic that you use for bonds, which is when interest rates are increasing, long duration bonds are punished more. There's a higher mark to market loss in long duration bonds versus short duration bonds. When interest rates are falling, there is a mark to market profits in long duration bonds versus short duration bonds. The same logic holds true in growth versus value. When interest rates rise, long duration growth companies get punished because their growth goes on for a long period of time. The discount rate brings down that future growth value. When interest rates fall, growth stocks actually start to do much better. So if Fed were to peak the interest rates at 5%, and then we see a fall in interest rates, it will be beneficial for growth assets. So that's another way to look at quality or growth companies versus value companies. Yeah.
So as you said, that interest rate actually plays a vital role while deciding which kind of stocks, basically, whether it's a growth stocks or the value style will perform. So in the current market, I'm sure you must be having some kind of views on the interest rate also. So any kind of a thought process on that front?
No, so I think interest rates would peak out. This is not my view. I think it's the general consensus view that interest rates will peak out sometime in Feb, March of next year, because inflation would have peaked out certainly by then. And at that stage, the Fed will basically take a pause for a few months, look at the unemployment data, and then if they see that the economy has slipped into a recession, unemployment numbers are increasing, they will start to reduce. So that's the typical cycle that any central bank would have followed in the last 50, 60 years. So you try to increase interest rates when you want to control the economy, when the economy is getting overheated, when things are going out of board. They want to slow down the economy to prevent overheating and the consequences of overheating. And when they achieve that, and the economy starts to basically show signs of slowdown, recession, unemployment, and all of these things, then they start to bring down the cost of capital so as to induce growth. So I think the interest rates may peak out sometime within the next 2 to 3 months, and from there on, for the first few months, stable, and then reduction.
The very next slide, you have shown us a return of the different styles and along with the blend. So, as a layman or as a investors, why one should go for a different theme-based kind of a funds rather than a blend kind of a style? Because in this slide, I can simply see there are not much difference, but the extremes, if we see of the value or whether of the quality side, there it's too much. So why not to go for a blend? And I mean, how the different kind of a styles plays a role while constructing the portfolio?
So, sure. So I think you can either go for a blend, or you can go for what we propose, a mix of both value funds and growth funds. See, a blend is difficult because what we've realized is that every individual has a particular way of thinking. Now, a value manager would always think of buying an SBI or an NTPC versus, let's say, a Kotak or an expensive, capital goods company like a Grindwell Norton and so on. Uh, on the other side, the quality manager would never want to touch a Bank of Baroda. He would always want to, buy, let's say, a Bajaj Finance and so on. So I think individuals have very different way of thinking. In blend, you are saying that the person would be able to, look at value and also be able to look at high growth. Usually that's a very different trait to practice, because you're really talking about a character who's basically looking in both directions and able to spot opportunities in both directions. Instead, what we have realized, when we look at our entire team, that we either have growth managers or we have value managers. We do have certain funds which play the blend, but we realize that playing that is not easy for the individual, and it's also very difficult to explain to the investor. If you ask me, okay, this is a blend fund, how do you play it? It's very difficult to explain to you what are the kind of companies that I like. So I think, from our perspective, we realize that investors should have a mix of both value and growth styles in their portfolio, so that on a portfolio basis, they don't face this huge volatility whenever one style is doing well and the other side is doing poorly.
So you mean that every time investors, whenever the investors are building their portfolio, they should combine both the strategies in their portfolio.
Correct.
Okay. My next question to you, as you shown us the slide, that there are the different cycles of the theme or the styles. UTI FlexiCap is one of the fund you are managing, and that particular funds within the category, if we see that the performance, we cannot see the performance. Though the question repetitively I receive is, market is at all-time high, why the fund is not performing? So I just wanted you to, take this question and answer our viewers.
Sure. No, that's a very valid question. In some sense, the answer is also there in front of you. How quality has behaved versus value in the last 1 year and the last 2 years. So we've stuck to our quality theme, and I'm sure you already know what the fund believes in, but I'll repeat that very quickly for you and all the other participants on this call. So, we've always said that the investment philosophy of UTI FlexiCap is quality first. The business have to have high return on capital. The business should have high return on equity. The business should generate strong cash flows. The business should have a strong balance sheet, and so on. And once we have found this business, the next thing we want to do is we want to find within quality businesses that can continue to grow very strong. So it's a combination of quality and growth that works for us. If you look at our portfolio, you will not find us owning anything which basically doesn't have this attribute of quality and growth put together. You won't see any other typical PSU names in our portfolio. And PSU, we all know how the PSU banks have done in the last 2 years. In fact, the worst performing banks are HDFC and Kotak. The best performing banks are indeed SBI and BOB. Does that for a minute mean that Kotak is, SBI or BOB are better banks than Kotak and HDFC? The answer is no. We are always focusing on the business rather than what the stock price is doing. In the long run, we feel that businesses like HDFC and Kotak are much better placed to create sustainable wealth, and not the typical PSU bank. It's a very different thing that in the last 1 and 2 years, the PSU banks in terms of stock prices have done very well, even though in terms of their business outcomes, they remain extremely poor. So, for us, it is accepting the fact that at any point of time, you could have a phase where your style is not doing well. Please don't get bogged down by the performance of your fund. Always keep checking what are the companies that you're holding in the portfolio. Is there any problem with these businesses? If there is no problem with these businesses, continue holding them, because these things reverse very, very fast. So if I think that Bajaj Finance is still one of the best NBFCs, if I think that HDFC Bank is still one of the best banks, I will continue holding them and not diluting my focus. So I think that's one very important thing that we all have to appreciate and understand. Now, why are we so convinced about this? Let me show you a few charts. I've just randomly picked up 4 stocks from my portfolio. And what we have tried to do is we just tried to see, look, how have they behaved over the last 12 years? So let's take Info Edge. It's a stock which is down 50% from the top. Today, maybe it's down 35%, but it fell 50% from the top in June, July. Despite this sharp fall, the stock has delivered a return of 26% CAGR over the last 10 years. And I think everybody would agree that this is 26% CAGR is a very, very rare kind of return that you see. Has the stock been a perfect ride in the last 12 years? Answer is no. Every 2-3 years, we have seen significant corrections in the stock price. We saw in 2014 a big correction. We saw a 30% correction in 2015. We saw a 20% correction here. We saw a 45% correction in 2020. So, despite giving you a long-term return, it has suffered many corrections. Now, you could have actually gone into these corrections, lost 20% and said, look, this is not working. Instead of Info Edge, I'm better off holding something else which is doing well. But then you would have missed out on the great compounding that this business has to offer. And the compounding of this business has been, between 15 to 17% in terms of profits, very, very high return on capital. So, we are always looking at the business outcomes. So long as we feel that in the next 5 years, Info Edge will continue to grow at 15, 16, 17%, while generating very high return on capital, by which it will generate strong cash flows, we will remain invested into Info Edge. In fact, if anything, we will buy more, which I'll show you later. Similarly for Jubilant, another stock that we own in our portfolio. Despite the 50% fall again, it showed you 25% long-term CAGR. Is it the first time that Jubilant has fallen? It fell 30% here, it fell 50% here, it fell 33% here, it fell 36% here. In all of these businesses, if you only look at the stock price, then all you're doing is going in and coming out. And that's the reason why majority investors are not able to create wealth. Believe me, trying to predict or trying to react to stock prices will never make you money. You have to basically look at the business outcome and continue watching that to make long-term money. You have to stick to your bets. And why are we confident about the future? Because we see a business like Jubilant continuing to do well. The QSR opportunity, either in Domino's, many of you may be aware that it has also taken a franchise for a global chain called Popeyes, which is the second largest chicken brand after KFC. So they're adding more growth levers for themselves. Mindtree, another company which we like, same story. It's fallen 20% here, it's fallen 45% here, it's fallen 34% here, it's fallen 45% again. Of course, in the last 1 year, growth stocks have fallen slightly more than in the past because of the huge increase in interest rates, which happened unexpectedly. When interest rates reverse, the same reversal will also happen, is something which I can tell you with confidence. What are we looking at? We are looking at these bottom long-term returns of 30% despite the fall. 1st April 2010 to 22nd November 2022. So despite the fall, Mindtree has given me a 30% CAGR. That is what I'm excited about. That is why you would see that even if our performance on a 1 or 2 year basis is poor, UTI FlexiCap's performance on a 3 and 5 year 5 year basis is still one of the strongest, because we are looking at these outcomes. Now, you may say that, look, I invested in 2021, therefore I've been hurt. All I can say is you may get hurt again if you exit today and invest into a fund which is doing well, which may be a value fund which has done very well in the last 2-3 years, but may not do as well in the next 2-3 years. So you will also have to stick to your core holdings. If you like the philosophy of a particular fund, if you like the strategy, if you like the thinking, if you like the portfolio, you have to overlook the near-term performance and only just keep holding on to that. So that's what we do when we hold on to our stocks. I guess that's what you as an advisor will have to do when you hold, let's say, 10 different mutual fund schemes. So there is no shortcut. You just have to remain patient and be sure that what you are holding inside the portfolio is indeed great quality. Let me just very quickly cover one more thing before you ask me the next question. How do we react? Is it that we just buy and forget and do nothing? Let me take 3 examples or 2 examples. Let me talk about Info Edge, that very stock in 2020. It was the highest sold stock in our portfolio. It went up 85% in a 1 year basis. It went up 82% CAGR on a 2 year basis in 2020. Remember, 2020 was the year of internet stocks going up. It was the highest sold stock because we said that, look, we love the company, we love the business, but the valuations have become so high. Let us actually sell it and buy something, which hasn't gone up so much. HDFC Bank, HDFC Limited, Kotak Bank were the stocks which we were buying the most because banking sector was not doing well in 2020. And we were selling Info Edge, we were selling Bajaj Finance, which had gone up much more than, let's say, all other banks. We were also selling Divis. If you come to 2022, it has reversed. The stock which I have bought the most is Info Edge because it's the same business which I like, and I'm buying it more today. And it is my top bought stock in UTI FlexiCap. Stock is down 40%, but that's giving me an opportunity. I would say, that is the kind of framework that even you need to have. If you are bullish on a particular thing and it has fallen down and underperformed, instead of saying we want to sell it and exit, you should say that, look, am I convinced about the longer term? If you are, then the only rational behavior is buy more rather than exit and sell out. And this chart basically tells you exactly that. Mindtree, it went up 188% on a 1 year basis and a 143% CAGR on a 2 year basis. 2021, this was the highest sold stock for us. By selling, I don't mean I exited, but by selling, I mean that, look, it had done so well. We said, let's just reduce exposure and buy something else. Today, in the last year, Mindtree and Infosys, these are the IT companies. Infosys is the second most bought stock for us in 2022 at the bottom, and Mindtree is amongst the top 5. So that is what we do. Evaluate the business. Market is only giving me an opportunity. If I buy something which is going up and sell something which is going down, then I'm not benefiting from the market. I benefit from the market if I have a rational behavior and I buy something which the market is punishing without the longer term opportunity, or rather with the longer term opportunity still being as solid. And I basically, sell something which has gone up 100% without there being any significant change in the longer term opportunity. So that's the rational behavior which investors should possess. Yeah.
Ajay, you had mentioned that the whatever kind of a stocks and the cyclical, you said that the stocks give you opportunity to buy more at a various. Since 2016, I think you are managing this particular fund. Uh, just wanted to understand what is, in technical language, what is the turnover of this particular ratio and how much portfolio, you particularly hold are holding since 2016.
So our portfolio turnover ratio has been around 10% forever, which basically means the inverse of portfolio turnover ratio is basically your holding period. If portfolio turnover ratio is 15%, you are holding things for 7 years. If the portfolio turnover ratio is 20%, you are holding your portfolio for 5 years. If your portfolio turnover ratio is 10 years or lower, you are holding your stocks for 10, 11, 12 years. So that's our portfolio turnover ratio. In fact, it has only come down because we are more and more convinced about what we are holding in the portfolio. We are backing those very stocks rather than selling Kotak and buying, let's say a Bank of Baroda.
So that's the only change as of now in the portfolio you are doing. Apart from all the stocks, more or less would remain same.
I would say no big changes in the portfolio in the last 12 months. The only change is whatever has come down significantly, we have bought that and we have funded that with, like I showed you, something which has moved up significantly. So for instance, Schaeffler is up 65% last 1 year. It is my most sold stock. That doesn't mean I'll exit the stock, but yes, it gave me an opportunity to take some money off the table to, let's say, help me buy something else. Similarly for Grindwell Norton, which is up 64% over the last 2 years CAGR. So yeah, I mean, that's the only churn we do within our portfolio. We don't change our portfolio's complexion. Within our portfolio, something is doing well, something is doing poorly. We try to go out and see that, look, is this doing poorly because something has changed significantly in the business? If the answer is yes, we will exit. If the answer is no, nothing has changed for Mindtree. It's maybe the narrative around US recession, around let's say how IT stocks are being beaten down today, but the business will be as resilient as it was in the last 5 years. You're getting it significantly cheaper, go out and buy it more. So that's the framework that we use.
Theme or any kind of a sector in this market you believe could be in that kind of a sector or the theme which you believe as per the market it might go up?
Ritu, if you were to follow themes, then you are basically digging a grave for yourself. The sooner you come out of this mindset of themes, the better for you, because there is nothing thematic except for some interesting talking points for the sales guys. For a pure investor, there is nothing known as thematic. You just need to have a strong philosophy of what basically works in the long run. For different people, it will mean different thing. Like I said, for a value manager, he could be excited about something else. A growth manager could be excited about something very different. You need to stick to it and not get sucked into these themes. So, the other day somebody was asking me a question, why did you not change your portfolio with, let's say, crude going above $100? And my answer to him was that if I start doing that, then every 3 or 6 months, my portfolio will keep changing, because I can keep talking about the value of crude over the last 5 years, and you will be surprised as to how crude has been volatile. So we saw crude actually, I think I have a chart somewhere which explains it. So we basically had crude in 2014, just before Mr. Modi got elected, at over $100. It collapsed and remained collapsed for a couple of years. Then it suddenly went up in 2018. Then it again within 1 year collapsed. This was not a collapse. This is basically when crude went all the way to zero or negative. Some of you may remember in 2020, it actually went to negative. People had to pay to actually, let the buyer take a delivery. That was the extreme scenario in April, May of 2020. Then suddenly, it went up. This is when people said this will go to 150. It then collapsed. Now it's at 75. I don't know where it will be. If I start running my strategy on the basis of interest rates, inflation, crude, all that you will see in my portfolio will be a 50% churn. By the way, don't be surprised if you take the industry average for all mutual fund schemes in India, the average is 55% portfolio churn. So I don't wish to do that, because all I wish to do is buy great businesses, hold them on for a fairly long period of time, be patient with them. Till the time I'm convinced that Kotak and HDFC indeed are the best banks in the country, why should I feel sad about the fact that they are the worst performing stocks of the last 2 years? I know that there will be a time, what people don't realize is that equity markets follow a 80-20 rule. 80% of your wealth gets created only in 20% of the time. This is not a linear business like owning a bond or an FD, where if the bond gives you 8% return over a 5-year period, then you need to divide 8% by, let's say, 60 months, and you will get your return every month in a linear manner. This is a business where maybe the stocks that you own don't do anything for 2 years. In the third year, they go up 100%. That's the reality of the stock markets. 80% of your wealth gets created in 20% of the times. If you act funny, if you try to time the market, you will miss out that 20% of the time, which I don't wish to do. So therefore, we will follow a sensible strategy. We will continue staying invested in these businesses. I know for a fact, anybody looking at that portfolio will realize that these are the winners and the structural, businesses that India has to offer. Just be patient with them.
Ajay, this question purposely I have asked you because last time we were having one-to-one kind of a conversation, and the same kind of a reaction I have seen from your side. So the same kind of a reaction I just wanted you to, our audience to see, because generally being a sales, this is the one very common question, like what kind of a theme or sector will perform, or why fund manager is not, taking or changing their own strategy, because we are giving them money and they should know what all the stocks will perform going forward. And that is what we are, paying a fee to them.
You know why 80% portfolio managers underperform the benchmark? That's something which all of you know. Even in the long run, forget 1 or 2 years where the numbers can be very punishing. But even over a 5 and 10 year period, the reason why most 80% fund managers underperform the benchmark is because of this itch. They always have this itch to do something, to react, to find the next trend, to rotate the sectors. And that's why they can't stick with any one particular thing which in the long run will make money. So I think that's a big learning that we have at UTI. We don't want to get sucked into themes and narratives and why didn't you do this and why didn't you do that. We much rather prefer people calling us slow and dumb. But I think our longer term performance is something that we feel should talk about our processes rather than we creating stories about why now rotating from one sector to the other makes sense.
So just to tell our audience, I would like to, tell UTI is one of the AMC which follows, very clear bifurcation among the fund managers are there. Like, the growth-oriented fund manager will manage or managing a fund which is only a growth-oriented stock they will cover up. Or the value side, veteran is there, he's managing like kind of a value theme. So I, really like that kind of a bifurcation where the very clear thought process, because one person cannot manage, as you said, both the styles. And specifically, when we talk about the bottom-up strategy, as Sir very clearly mentioned that he focuses on the businesses. So in UTI, you can see despite the underperformance, he's so confident on his style and the investment philosophy that nothing has been changed. So I really appreciate that, because to hold that underperformance for a brief period of time is also a really commendable job. Because generally, as you correctly said, that because of the underperformance, lot many fund managers try to go and change their holdings based on the market.
No, thank you very much. Thank you, Ritu, for that appreciation. But yes, you're right. At UTI, we try to follow this process across different styles and strategies. That's the one thing we are trying to achieve. If we are able to do that consistently, then I'm sure our different strategies will all have strong longer term outperformance. Although from year to year, they may actually be underperforming or outperforming.
Okay, so main reason to keep today's call was just to highlight the UTI flexi cap, because we have been recommending this fund since quite a time, and our client are holding this particular fund. So I thought let's have a your views on that particular fund and to our sales team as well. Uh, Anything, sir, you would like to highlight here?
Well, just a couple of points maybe I want to highlight for the broader audience, because you people must also be questioned by our clients around whether the markets are expensive, cheap, what should we do, and so on. So I think this is a chart which I'm sure you see it in different shapes and forms, but important to keep this in mind. Markets indeed are trading at let's say 20 to 25% higher than long-term averages. That's not a number which gives us any amount of comfort. There has been a very strong low quality stroke value rally in the last 6 months. The kind of businesses that have gone up in the last 6 months just brings back the memories of desperation to actually cling on to anything which can make a quick buck. So that's something I would just caution all of us. Please don't get excited about the markets. Whenever markets reach such high valuations, the next 6 months can be troublesome. The India growth story is intact, so therefore, longer term, super bullish on the markets, but shorter term, basically, I would basically just say that uh, you know we should just hold on to our excitement. The numbers are telling us a very different picture. Last time we were at these valuations was Jan 2008, pre-Lehman crisis, and we know what happened. The world is not looking at such a large problem today, of course, but yes, valuations have to be kept in mind. Second is large cap versus mid cap. I see a lot of excitement happen in mid cap even today. All this chart is showing you is that the longer term mid versus large parity is that of almost equal valuations on price earnings multiple. The longer term average, as mentioned here, is minus 0.59, which means almost same valuations of large versus mid. There are phases when large caps do well. There are phases when mid caps do well. This was a phase in 2018-19 when large caps did well. Last 2.5 years, almost 3 years, mid caps have done very, very well, because of which their premium to Nifty or their premium to large caps is now 19%. This cannot sustain for a long period of time. So be watchful about the markets, be more watchful about the mid caps. That seems to be an overheated space. So those are the two important things which I wanted to highlight.
Okay. Thank you, sir. Thank you for giving us a view on the investment philosophy side and on the specifically on the UTI Flexi Cap Fund, and believing us, to we really believe that the particular strategy, or if you hold that particular fund and you really believe on certain strategies, you should hold that particular fund for a longer period of time rather than selling. You can as you said that next 6 or 8 months might be little volatile, so this might be a good opportunity for the investors to add in this particular fund. uh, we have Mr. Vijay here from the UTI team. Sir, over to you if you would like to add some points here to our team.
Yeah, thank you, Ritu, and I'm audible?
Yes, yes, very much.
Yeah, thank you. I think so. Thanks for giving us an opportunity, and I think so. If the questions means you have, that was a good thing that you had taken the questions from the team, and it is a it's a good way to get the clarity. Even if the team is having some questions or some they want clarification, they can talk to us or they send to us or they can connect with our team. The philosophy of the investment, which Ajay spoken briefly, it's also available on our internet. It's a document which is there, which you can. It's in the public domain. You can go and check the philosophy things. If you want, we can share that to you also. Thanks, Ajay, and thanks, Ritu, to provide us an opportunity.
Yeah, thank you. I enjoyed the discussion, Ritu. Really very, very thought-provoking questions from your side, and really appreciate the fact that you too have a very longer-term outlook. All I can say is that this is the one thing which is the competitive edge which any investors can possess. So yeah, all the best, and we also do hope that we come out, basis our process, we come out with great long-term track records which can help your investors create wealth through you. So we are also pretty much on the job. Hopefully patience will pay off.
Thank you, sir. Thank you for coming and having a discussion with us. So today's discussion we close it here. Thank you, audience, for coming and listening patiently. Thank you so much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.